Assalamualaikum and a very good morning. My name is Nurdayana Batusha binti Jamali with matrix number A193294. I am the fund manager for Group 5 and I would like to introduce my group members.
I am Muhammad bin Ismail, A194817.
Hi, my name is Ella Zafni binti Zakaria and my number matrix is A196402.
My name is Muhammad Shafir Idham bin Shafrin with matric number A195859.
Hi, my name is Nur Aini Sofia binti Zulkifli. My matric number is A196001.
My name is Muhammad Ani Iqbal bin Wiradana. My matrix number A196019.
Assalamualaikum warahmatullahi wabarakatuh. I am Dami Histina binti Fars Abila and my matric number is A196063.
For this project, we are given a task to generate an optimal risky portfolio and complete portfolios for different investor types using selected shares. Let's begin with the assumption for this project. First, we are using a government security yield which is equal to 3.18% per annum. We also derive the weekly risk-free based on the annual yield as shown in the equation on the slide. Moving on to the selected shares, we have chosen 4 stocks which is EA Holdings Berhad, Zentech International Berhad, Key Alliance Berhad and BCM Alliance Berhad. These stocks have been selected from different industry to create a diversified portfolio. The industry we have included are technology, retail and holdings, offering a mix of high growth and stable assets. This diverse selection mimic a real-world scenario where investors combine various assets to balance both risk and potential returns, ensuring that the portfolio can adapt to different market conditions. Additionally, these stocks were chosen because they provide varied performance profiles, helping us to analyze both high risk and low risk options for different investor types. Lastly, historical data for these stocks allows us to better evaluate their performance over time, ensuring we make informed decisions when constructing the optimal portfolio. So, this is the data for each companies. We categorize the data in 3 components, which is average return, standard deviation, and covariance. The average return indicates the mean weekly return, showing how much a stock earns on average over time. For instance, K Group Berhad has a high return of 32.69%. The standard deviation measures the volatility of risk, showing how much the returns vary from the average. K Group is more volatile with a standard deviation of 60.36%, meaning its returns fluctuate widely. While Zentech is less risky at 25.71%, showing more stable returns. Finally, covariance measures how two stocks move together. If they have a positive covariance, they tend to move in the same direction. These values help us understand the potential risk and return of each stocks and guide us in building a diversified portfolio. This data was calculated from historical weekly returns for each companies from January to December in 2024.
After we obtain the data and we calculate it, we can go through to this section, which called optimal risky portfolio. First, we analyze the portfolio weight allocations. As we can see from the pie chart above, K Group has smallest allocations, which is just 1.3%. Meanwhile, Zentech has the largest allocation, which is 53%. These allocations based on the expected excess of return, which is have shown in panel A, and covariance matrix in panel B. As you can see, the green color in panel B is diagonal values, which represent each stock's own risk, or we call it as variance. So, the expected return for K Group is the largest one, as well as its variance. K Group can give us high return, but we need to remember it also have very high risk. So we need to set minimal allocation for K Group to limit its high volatility impact. While for Zentech, we have the lowest expected return and the lowest variance. That means it has moderate risk. This means Zentech has dominant position due to best risk-return balance. Next, we also calculate some values for portfolio performance metrics, which contains expected return, standard deviation, and Sharpe ratio. For expected return, high values can show good growth potential for the portfolio. Low standard deviation suggests the portfolio is well diversified and stable, and very high Sharpe ratio means the portfolio is optimally efficient, which can delivering maximum return for the level of risk taken. Next, we make an efficient frontier graph for all stocks. So, why we make this graph? We make this graph because we can maximize returns for a given level of risk, or we can minimize risk for a given return. The optimal option, which is the best risk-adjusted return, we use the highest Sharpe ratio, which is 9.39, with the expected return 0.1713 and standard deviation 0.01825. For the safest option, we use lowest risk and the lower return. Otherwise, we can have two allocation strategies. First, we can invest in balanced mix. For example, we can invest 40% in BC Mall, 39% in Zentech, and 8% in K Group, so that we can achieve optimal portfolio. Next, we also can invest heavy in stable assets like 60% for Zentech and 20% for EA Holdings to get safest portfolio. They will have moderate investors who seeking strong returns without extreme risk. They also will have conservative investors who prioritizing safety over returns. And then they also will have aggressive investors who willing to take bigger risks for higher potential gains.
Now, I will explain the portfolio for a risk seeker investor, which the risk aversion value is -5. This type of investor is willing to take big risks for a chance of a high returns or high profits. That's why the portfolio is very aggressive with 150% in risky assets and -50% in risk-free assets, meaning that the investor borrows more money to invest even more. And the highest allocation in this portfolio goes to Zentech because it gives a high return with reasonable risk. And the lowest allocation is given to K Group as it has the highest risk among all the stocks. And the utility value is 0.18935,839, which is quite high, and it means that the investor is likely to be satisfied and favored to the portfolio because it matched their goal of high return despite with high risk. Next, we have the risk neutral investor where the risk aversion value is 0. This type of investor are not considering about risk at all, and their main focus is to get the possibly highest return or profits. So the portfolio is 100% in risky assets with nothing in risk-free assets. Just like before, Zentech has the highest allocation because it performs the best, while K Group again has the lowest allocation due to its high volatility. Therefore, the utility value is 0.1231923, which is the same as the expected return. Since the formula of the risk neutral is utility equals to expected return as A equals to 0. And since risk is not considered, the investor values the portfolio purely based on risk. Now, for the risk-averse investor who has a risk aversion value of 5, this type of investor wants to avoid high risk and prefer a more balanced and safer portfolio. That's why the allocation is 70% in risky assets and 30% in risk-free assets. Therefore, Zentech is still the highest allocated stock because it offers good return with moderate risk, while K Group is the lowest again since due to high risk doesn't match the needs of a cautious investor, which can impact the performance. Therefore, the utility value is 0.8535542, which is a good sign. Even though the return is quite lower, the investor gains more certification because the risk is well managed. To summarize all three investor types, we can see that their portfolio allocations and utilities are based on their risk preference. for the risk seeker is the most aggressive one with 150% in risky assets by borrowing money to invest even more. They get the highest utility despite the biggest risks that they took. Next, the risk-neutral investor invests 100% in risky assets, focusing only on return. Hence, their utility equals the return. Finally, the risk-averse investor chooses a safer path with 70% in risky assets and 30% in risk-free assets, resulting in a more balanced and stable utility. Across all three portfolios, we can also see the benefits of diversifications. For example, like Zytec and BC Mall, which have a negative covariance, which means that they move in opposite direction. For example, like when the price Zytec is go higher, the price of BC Mall go lower. This helps to reduce overall portfolio risk. Lastly, the optimal risky portfolio, which combines the best performing stocks like Zytec and BC Mall, achieve a high Sharpe ratio of 9.39, showing that the return is very good compared to the level of risk. In conclusion, every investor is different by understanding their risk preference, and we can design the portfolios that match their goals, whether they want the high returns, balance, or safety performance.
In conclusion, what we have learned is that different investors need different asset allocations based on their risk preference, and this directly impacts the returns and risk they can expect. Diversification is super important because it helps spread out the risk across various assets. The efficient frontier also plays a big role in guiding investors to find the best possible return for the level of risk they are willing to take on. At the end of the day, understanding all this helps investors build smarter, more balanced portfolios that really match their financial goals and comfort with risk. That's all from us. Thank you.